Welcome everyone to this week's Beginner Circle webinar. For those of you who are joining us for the first time, the purpose of these webinars is to help our newer members become acquainted with how to use our site and answer any questions that you may have regarding Elliott wave theory, regarding technical analysis, regarding Fibonacci pinball. And of course, we can take a look at the usual suspects, which are covered in the main market section of our site. So that would be the S&P 500, gold, silver, GDX, crude oil, and the US dollar. I can also take a couple of requests if we have time near the end, depending on how many questions we have. But I do ask that any individual stocks be saved for our Stockways webinar, which is after the close on Thursdays. So that would be tomorrow. So as I'm going through the charts, again, any questions regarding those topics that you have, feel free to enter them into the questions box and I will address them as we go along. So starting off, I typically start off with the S&P 500 weekly chart, which is what you should see currently pulled up on my screen. And we continue to track the impulse off of the 2009 low here in progress, viewing the primary wave 4 of that impulse complete into the March low earlier this year as an expanded flat. So the initial A wave of that primary 4 completed in December of 2018. We got a 3-wave rally for a expanded B wave into the February high earlier this year, and then that sharp drop into the March low to complete the expanded flat as the primary wave 4. So the expectation with primary wave 4 complete into the March low earlier this year is that we are now beginning primary wave 5 to the upside. And under that assumption, I still believe that we are working on or have already completed, and this may be working on wave 2, but still just the initial 1-2 start to that primary wave 5 filling out. So under that assumption, into the earlier June high on the S&P 500 chart, we have what counts very well or reasonable as a possible leading diagonal up for that intermediate degree wave 1. We got the initial drop into the June 15th low, and price has kind of slowly been climbing its way higher since, and more recently did slightly exceed the prior high that was made earlier in June. So my opinion, I still see the majority of individual stocks supportive of the count you see here on my chart. Again, that leading diagonal complete into the early June high, initial A wave down into the June 15th low, 3-wave bounce into the high that we saw last week, possibly completing wave B as an expanded flat for the wave 2, and ready to roll back over and fill out wave C of that expanded flat, give us that nice proper sized wave 2 before we break out to a new all-time high in the wave 3 of 3. The alternative way of viewing this, and especially if price does not roll over from here and instead continues to climb higher, this is still working on the initial wave 1, and this is one of the potentials that Avi has been going over and illustrating over the last several weeks. So rather than all of wave 1 complete into that early June high, maybe just wave 3 of 1 pull back as wave 4 into the June 15th low, and potentially can stretch a little bit higher in the wave 5 of 1. As I said, I don't see that as the better representation or the overall representation of what the majority of individual stocks seem to support, but price continues to not otherwise break enough support to confirm that we've already topped in that blue B wave. We do have what can reasonably count as a potential micro 5 waves down from the high that was made last week into the Sunday session low that we saw at the beginning of this week. This is the ES chart. And the initial bounce that we got off of that low, pretty clearly only 3 waves. So that's kind of strike 1 towards a strong setup to continue to extend higher from here. The pullback into the overnight low last night was corrected as 3 waves, and we've since rebounded back up above the prior high earlier this week. So a wider flat is an ABC. If this is the initial 1-2 off of last week's high, still very much a reasonable interpretation of the structure currently. So today's price action basically fulfilled the majority of that C wave. It could attempt to push a little bit higher here overnight, or maybe even potentially into tomorrow morning before that wave 5 of C completes. We're looking at resistance at roughly 32.62, the 764 retracement of our move down from last week's high. 786 would be just above there at 32.64. So again, if it wants to stretch a little bit higher here near term, then that is the next resistance region to watch, 32.62, 32.64. Again, this is the ES chart, the futures of the S&P 500. But if, again, a corrective bounce, that is where price should attempt to put in the next local top and turn back down if it is going to then head below the Sunday session low next in a possible wave 3. If instead 32.64 is breached on a sustained breakout, then that increases odds of revisiting, retesting the high made last week and potentially pushing past there as, again, what could be the wave 5 here of a larger wave 1 still in progress. As I said, though, in the majority of individual stocks that Zach and I track on a regular basis in the stock wave service really seem fairly full in their respective counts. Many things still well below the June high, and many things really arguing very strongly for a B wave off of the June low, either already complete or very close to completing. So I'm just not seeing evidence, strongly or clearly pointing towards that further extension to the upside in the red wave 5 of 1 from here. But until we take out more support, we at least have to recognize it as a possibility. So let's see if we have any questions yet coming in. First question from Christopher is, once you've bought an initial tranche, do you set limit orders for the next tranches strictly on the next fib levels down below that initial buy, or do you set limit orders at increments between fib levels? So usually when I am setting limit orders to layer into a position, in most cases a long position, so for example, stocks that have pulled back, gotten more of a pullback than the broader market and are already starting to enter into target support for a corrective pullback as a wave 2. Many cases I will set limit orders at each retracement level. So initial tranche would be filled if price hit a 302 retracement, then the next limit order at the 50%, and then the final order at the 618 retracement. And if that final order doesn't get filled and price instead, holds the 382 or the 50% retracement for a bottom of wave 2 and turns back up, then I look for the initial 1-2 start to that wave 3 or wave 1 of 3 as the next opportunity to add to the position. So to answer your question, my limit orders are usually set just barely above fib support levels. I usually don't set them exactly at the fib support because sometimes they're not tagged to the penny. So I give it a little bit of cushion there, setting it just above those support levels. Next question is, if there is any pullback overnight, what would be the support level? If price does start to turn down overnight, support is still currently at 32.34 roughly. That would need to break as the initial piece of evidence that price has finished our wave C of 2 here and is potentially rolling back over and starting a third wave back below the Sunday low and the low made last week. Next question, if we go to the red wave 5, how high does the blue wave? Well, we would, if we do continue to stretch and it looks more like an extension of the wave 1, then the fibs would be moved up and measured from wherever that high was made. So that would pull the target region, the 382 to 618 retracement for wave 2 up a bit. But if this is an extension of wave 1 and not the B wave of an expanded flat, then that means that the pullback as a wave 2 should be an A, B, and C, rather than a more direct drop is just a C wave here, as the blue count suggests. Question from David is, what do I mean when I say a stock chart is full? So when we say type when we're posting a chart that the count looks full, what we're referring to is that all the subwaves that are expected with an impulse or corrective ABC or whatever the structure is look complete. All the subwaves are accounted for. The fib targets, standard fib targets are being reached for respective subwave counts, and basically the count looks complete. So when we say full again, it looks like the count's complete, and therefore the expectation is that you will see the next stage. So following 5 up, you'd expect a corrective pullback as an ABC. If an ABC to the downside, then you would expect that correction to be completing and beginning to turn back up and another start to an impulse. Question from John, is there an ETF for biotech stocks? What does it predict in the future? So we're not going to go over any individual stock charts here or the ETFs again for the Stock Waves webinars when we would look at things like that. But the two most popular biotech ETFs are XBI and IBB, if you are interested in taking a look at those. And we do have analysis of both those already posted in the Stock Wave service. Question from Chris, if your blue count is correct, is it at all likely that the retrace for wave 2 could go below the resistance box, i.e. below 2,500? I mean, anything is possible, but I would say probabilities of that are relatively low. In fact, I would assume that price is more likely to hold the upper end of our target range here, but still hopefully getting close to 2,800. That 382 retracement is kind of the minimum expected target for wave C of 2. So could it go below 2,500? Yes, it's possible. Would probability strongly support that? Not from what I'm seeing. Question from Sam, on the microscale, was that crazy Ivan on SI this afternoon an ABC or 1, 2, 3 retrace after 5 waves up? Sam, we'll take a look at silver in a second here, and we can go over the micro price action there, but I'm going to answer questions on the S&P first. Question from Hadrian, do I expect the Dow Jones to follow a similar path? And your second part of your question, and timing of SPX. So just a quick note about timing. Elliott wave analysis doesn't really have any specific timing component built into how the analysis is calculated, etc. Really, any placement of specific labels is just a rough estimate based on the proportions of the rest of the structure, not necessarily, again, strict calculation based on anything. So Elliott wave theory, purely based on price. Those placement of labels, rough estimates, not necessarily an accurate prediction of when those labels are likely to get hit or when those levels are likely to get hit. But we can take a look at the Dow Jones in a second here. Question from Alberto is, does the pattern support a more bullish scenario than red? The only chart that I could potentially view as further along in primary wave 5 and not still working on the initial wave 1 would maybe be the NASDAQ. It has already exceeded its prior high that was made earlier this year, even by a decent margin already, and continues to show relative strength compared to the rest of the market, and again is further along to the point where it could be past the initial wave 1 of primary wave 5. As far as the SPX and the RUT, don't really see a strong argument to be made supportive of that. If you really wanted to force a very bullish count, again, I wouldn't view it as a high probability. You could technically count this as a very compressed muted leading diagonal into the April high as a wave 1, intermediate wave 1. Brief, shallow, short-lived pullback as wave 2. Questionable 5 up here is wave 1 of 3. Pullback into the June 15th low is wave 2 of 3. And this would now be the start to wave 3 of 3. Do technicals, fibs, price structure strongly support that? No. And this would be one of the weakest starts to the heart of a primary wave 3 that I've seen in a very long time. So I just don't see probability strongly in favor of that. There's not very many individual charts that look like they're about to embark in the heart of a third wave compared to those that look set up for a corrective pullback. As always, anything is possible, but we're dealing with probabilities here. Let's see, next question from Tanya is, if you see this multi-year bull market in the US future, does it tell you anything about the election outcome? Well, we can look at historical previous elections where an incumbent is up for re-election and how the position of the stock market going into that election affected the potential outcome. And in, I think, pretty much every case, if the stock market was trading near highs and had not seen a significant correction, then odds favored the incumbent would be reelected. So in this case, unless this crashes before November, odds would favor that Donald Trump will be reelected. Is it anything that I would say is certain? Obviously not. But historically, that has been kind of the pattern in the past. Next question from Robert. Double tops tie into elite wave or fib / fractal analysis? Not in any specific way. You can, as I was saying, get a full 100% retracement or even a higher high in a B wave compared to the initial wave A to the downside. So on a flat structure, I mean, it's pretty common for a B wave to retrace again the majority, if not all, of wave A, which would in most cases be viewed as a double top in traditional technical analysis, and then followed by the turn back down in wave C. But anything more specific than that, not something that really comes to mind. Question from Steve is, given that 401ks typically have more restrictions, i.e. excessive trading, no intraday trading, etc., what would be the most ideal way to use LE Wave for long-term 401k? I mean, I know there are, for example, college funds or other funds that you really are only able to make changes to once a quarter. Those are a little bit more difficult to, I would say, navigate subwaves effectively. So those are situations where you would be much more focused on the longer term expectations. I would be focusing on nothing lower than a daily chart and even maybe just a weekly chart. So looking at the weekly chart, I mean, the expectation is that we have further upside. So if you had that account, mostly focused on equities at the moment, I would say there's no significant reason to change that current positioning. Even with the expectation of a near-term pullback as more of a wave 2 before continuing higher. So it really just depends on kind of your restrictions and abilities within that account and how often you can make trades, and you should kind of focus on a specific time frame based on that. Next question. Can the circle C of B and blue also be viewed as red 5-1? So you mean move the 4 over here and view this as wave 5? Is that what you meant? I mean, it doesn't substantially really change expectations or outcomes. I would say it's a little bit more awkward to view the fourth wave complete into the June 29th low, but Sure, technically possible. But again, it doesn't really affect expectations very much or targets in any significant fashion. So more academic than practical as far as the difference. David then asks, what is the difference between pivot and support/resistance? I mean, there's not a substantial difference. It's just a difference in wording, really. Usually when an analyst uses the word pivot, you're just referring to a specific level where probabilities shift from one potential to another one. So, we'll say above this pivot level, opens door to this count, below it, the other count has the current advantage. Support and resistance could be different in saying that, these are specific support or resistance levels, but exceeding them or breaking below them doesn't necessarily change the probabilities of the count, the current count. Next question, for SPX, if it's the blue count, which is a leading diagonal, wouldn't you expect a deeper retracement in the wave 2? Yes, you are correct that typically, not always, it's not guaranteed, but typically, more often than not, if you have a leading diagonal as an A wave or wave 1, the subsequent pullback as a wave 2 or a B wave tends to be on the deeper side. So rather than usually we look for a 382 to 618 retracement, following a leading diagonal, you might be looking for a 50 to 764 retracement, unless that correction is either a wave 2 or a B wave. Instead, takes more time, ends up being a wider flat structure, which is the case that appears to be playing out currently. So that is why I'm comfortable viewing a pullback to just the 382 retracement as enough to complete all of that wave 2. So after a leading diagonal, either again you have a deeper pullback if it happens more sharply as a zigzag, or you at least fill out a wider flat that takes up more time. Next question from James. He asks, I've seen Avi sometimes use MACD for bottom-top confirmation. Can you please explain how he does that? So most usage of technical oscillators with elliott wave theory is going to be basically looking for positive or negative divergence. So when we see negative divergence building as price is approaching a potential top, then that just adds confidence to that support or resistance holding and setting up that next turn in the trend. You want to see negative divergence once you've completed a third wave and, for example, are filling out a fifth wave, or in this example, some negative divergence as price is filling out a B wave towards a new high. So just seeing that divergence just helps add confidence to the count that a turn is coming soon. Next question from Gustavo. Do I think that the 2020 March low was absolutely predictable based on EW analysis? I mean, I don't know what you mean by absolutely predictable, but I would say that we did predict it fairly well in advance, and I was very adamant in my analysis personally. I can't speak for everybody, but very adamant that this was the C wave completing all of primary wave 4 and not just an A wave down off of the high. And that was based on what I was seeing across individual charts, so many of them looking like that either expanded flat or just regular flat structure for the primary wave 4. There were just too many charts in agreement with, again, all of wave 4 completing into the March low rather than just an A wave of what would be a deeper corrective pullback. And that's kind of similar to what I'm seeing right now. Just there are so many charts that look either due for a C wave down to complete wave 2 or have extended a little bit higher into wave 1 and still need an ABC pullback for wave 2. Way too many to ignore, way too many to view probabilities any different than how I viewed them for the past month plus at this point. So. Next question from Hadrian. Since EW focuses on price patterns and not timing, what do I rely on to provide timing insights? Again, general proportions of wave structures can give you a rough estimation of where it might, where a specific pattern might end up completing. I also use fib fans to see how those align with horizontal fib levels to get a rough estimation of timing. Things like option expiration can also be used to gauge potential timing, since turns tend to happen around there. Specific events like Fed days as well often are associated with more significant turns. So there are various different things that you can use, but I would say predicting timing compared to predicting specific price levels is much more difficult in markets. I haven't really found any single methodology that stands out as being consistently very accurate. So if you have something, I'd love to look into it more, but at least my own kind of search for it has not yielded anything promising. Next question, let's see. Yes, we can look at silver. Just going to finish up any questions on the S&P 500 first. Question from John, do I expect a waterfall decline for wave C? Personally, I would lean toward it rather than a very drawn out, choppy ending diagonal C wave. I think that it would work well in putting some fear back into market participants who have become, by many metrics, very complacent again recently. So getting a sharp drop as the C wave would certainly make people question again, that the markets or that price never goes down, or that every dip is immediately bought, that things, the worst is behind us, etc. So I would like to see that. Can I say that it's guaranteed or even high probability? Not until we see more of the structure fill out. Next question from Belly. As a beginner, I have some problem understanding how in Elliott wave each chart should be seen on its own rather than in correlation. For example, the ES chart and the SPX chart have different wave counts. The ES dropped last night while the SPX just went up the whole day. So how do we relate both charts so that they end up expressing a very similar thing in the end, or how do we resolve their, sorry, I have to scroll down here, their contradictions? In an instance like ES versus SPX, I mean, they're basically a representation of the same underlying, the S&P 500 index. So there's really not going to be a substantial difference between both structure and counts on both those charts. You, of course, will see some after hours action on the ES chart that is not reflected during the regular trading hours for the S&P 500, in which case there might be a very, very slight difference in how those two charts are being counted on smaller timeframes, but usually the end result is the same. There's not really going to be a situation where, for example, we're looking for a substantial move to the upside in the S chart versus a substantial move to the downside in the SPX. They're going to be moving in the same direction. They're a measurement of the same underlying. So again, small variations, smaller time frames will happen because of that after hours trading. But overall, you're not going to see a substantial difference, especially the further you zoom out. Next question, is there a training video or written discussion on fib fans? I'm not familiar with how to create a fib fan. Well, if your software platform does support fib fans, then it's kind of very similar to the way that we do Fibonacci pinball. By that, I mean that you are measuring your fib fans based on the bottom of wave one, and then the top of wave one are your 2 reference points. And then that gives the fans going forward, which you can use to see where price lines up with specific fib levels. So for example, going back to the primary wave 1 and 2 here, you can see these blue fib lines are a little bit faint. I don't like to get my charts too messy, so I have them pretty faint in the background. I can see them. Hopefully you can see them as well. But measured from the bottom of wave 1 here, projected from the top of wave 1, and then you would see where those fib fans intersect with expected fib targets based on price. So for example, we had an intersection with the 100% common target for wave 3 of 3 back here in 2014. And then the next one was in 2015. It topped a little bit closer to the second fib fan there, kind of in between them, but closer to that second one before turning down. Again, it's not anything really exact. It's not something that I place a ton of emphasis on as far as timing, but it can give you a rough estimation where sometimes you will see those intersections happen. And another good example here is when we had an intersection with the 100% common target to be hit for a fourth wave after the third reaches a 1618. In this case, the B of the third did. And pretty good intersection as far as the timing for that wave 4 and the 100% there at the March low. Do I expect the VIX to go up significantly soon? We can take a look at the VXX a little bit later, probably near the end of the webinar, and I'll let you know my thoughts on that. Another question, can we do a beginner session on how to set up and just use the Motive Wave software? I purchased one and it looks like a lot of members have as well. There, I believe, actually is a video. Let me see if I can find it. So if we go to help and then intro to Elliott Wave education section, and then go to the webinars, the continuing courses in Elliott Wave, the very bottom one, charts and settings for optimizing wave analysis. I'm pretty sure I went into setting up Motive Wave in that one. If you want to take a look at that. Another question about Motive Wave here. Manny, did you set up your repository? That's really the only thing I can think of that might be the issue. I don't know if you can see this window that just popped up, but you have to use a external repository rather than the local database, and then it might show up those XML files in that folder for you to replace. Next question, is it a mandate to have all the waves, impulse, or corrections should end at any fib level? No. A specific wave does not have to complete exactly at a fib level. We just have targets that are quote unquote standard, more commonly hit than not. So for Fibonacci pinball, for example, we typically see a wave 1 of 3 target between a 382 and a 618 extension based on the size of wave 1. Then we see the wave 3 of 3 target between a 100 and a 1236, wave 5 of 3 between a 1382 and a 1618, and then the fifth between a 1764 and a 200%, looking for a little bit of an extension in the primary fifth in this case. But it doesn't have to be a specific fib level where turns are made, just there are levels that are more commonly seen for specific turns more often than not. Next question, do I consider the March low deeper than typical or expected for wave CF4? Actually, not at all. This is very, very typical Fibonacci, at least on the S&P 500 chart, very, very typical Fibonacci pinball price action. So as I was just kind of describing as far as standard targets, typically we see a wave 3 target between a 1382 and 1618, again, based on the size of wave 1 projected from the bottom of wave 2. So you can see those fibs here. The 1382 is about where our primary wave 3 topped, just slightly above that. But then we got an expanded flat with the B wave coming up and hitting the next fib, that 1618. And that is actually another common occurrence that you will see, again, not all the time, but when you have a third wave that comes up a little bit shy of an ideal fib level, so in this case we exceeded the 1382 but came well shy of the 1618, a lot of times you'll see an expanded flat then play out for the fourth wave, where the B wave will then go up and tag that fib level that the impulse, the prior impulse, the third wave high did not quite reach, then come down from the C wave from there. So normally after hitting a 1618 for a third, in this case again the B wave hit the 1618, you expect a 100% as the target for wave 4, which is where we bottomed in March. So in the case of the SPX, no, this is actually very, very standard proportions and sizes for the subwave structure so far. Other charts, specific stock charts, definitely. We got much deeper than standard or ideal pullbacks for a fourth wave. Also on the RUT, a little bit below what you would normally expect. On the RUT, after hitting a 1382, usually you're looking at a 100 to 764 as your target for the fourth. In this case, we dipped one fib lower to the 618, but still avoided overlap within the wave 1 price territory. Okay, so that looks like all the questions on the S&P 500. Let's quickly take a look at our other indexes, just to go over those briefly. RET, since I have that pulled up, I'm viewing pretty much identical to the S&P 500, and I would say even more convincing in this situation, in this instance, that it just looks absolutely textbook as a leading diagonal wave 1 complete into the June high. The subwaves all very, very supportive of subdividing into 3 waves as ABC, and just very, very weak price action off of that June low that still has not exceeded the prior June high. Just looks, very supportive. Odds continue to favor a B wave here and set up a twirl back over in wave C into that same 382 to 618 retracement range. And then somebody asked about the Dow Jones. I don't track it usually as closely, but as you can see here, so I don't have the rest of the labels on there, but very, very similar situation here. What looks like a leading diagonal complete into that early June high, and an ABC flat structure filling out since, in this case, also still below the prior June high for that B wave so far. Ready to roll over and potentially already starting that C wave to the downside. The NASDAQ is the one chart that has stood out as being much different. And really that is why I believe, obviously, that we've really struggled to see any downside follow through recently. It has been pretty much carried by those mega cap FANG stocks and other momentum growth tech stocks. A lot of the rest of the market is not participating to the upside with the same enthusiasm that we're seeing in those stocks. So, especially when you're looking at more equal weighted indexes and stuff, I think you get a little bit different looking picture than the indexes where we have a much higher weighting in some of those larger cap names. But it basically just speaks, in my opinion, to the narrowing breadth of this overall rally, and which is, I think, supportive of the fact that this is not sustainable and we will get more of a corrective pullback. So when there's less and less leadership, less and less breadth participation among all the stocks as far as what's actually participating to the upside and what stocks are actually driving that upside, that just speaks to, again, this being unsustainable. So I'm viewing what looks like a possible 5 up complete here as well, in this case into the more recent July high, set up for more of a pullback as wave 2 on the NASDAQ as well. Technically, when looking at the NQ futures, same as ES, versus the S&P 500, I could make a case that this is a 1, 2, 3, 4. You get one more marginally higher high as a fifth. I would still view that as 5 up completing though. Next question in the Dow Jones, the wave 1 of a leading diagonal is looking like an impulse of 5 waves, but whereas it should be 3 waves as per leading diagonal, how do we count the waves correctly? Let's go back to that chart. I will say that I wouldn't say that this is, absolutely impossible to interpret as 5 waves up, or sorry, as 3 waves up. You could view this as an A, B, and then C wave here. But I will say that there are situations, I think, that sometimes it's a little bit ambiguous when you're dealing with a diagonal. That initial move does sometimes look more impulsive than it does like a 3-wave structure, but then the rest of the subwaves as they fill out clearly begin supporting and confirming that it is leading diagonal. And this is just kind of a theory, but I think it's one of the situations where, the outcomes are never predetermined. And so what started as what could have been an impulse then morphed into a diagonal structure, which again would explain a potential impulsive looking wave 1 start and then the rest of the structure then proceeding to unfold as a diagonal. I do think it's a mistake that a lot of people make when using Elliott wave theory as their analysis method, is that sometimes people are very, very, very strict as far as the guidelines, the rules, and if something isn't absolutely perfect, they dismiss it as not being a possible count. When we know that markets are much messier, much more fluid, much more variable than that, especially during corrective pullbacks. So a lot of the rules, for example, that you will see in the Frost and Prechter book are things that I have found not to always be the case. For example, that zigzags must subdivide as 535. I have seen countless zigzags where the A wave subdivides very clearly into only 3 waves, but the rest of the structure is very, very supportive. The rest of it looks exactly like you would expect for a zigzag, basically. So. Okay, that should address all the questions on the indexes. Let's take a look at gold and silver next. Starting off with the gold chart, I'm going to zoom out here on the weekly, just get a sense of where we are in the higher time frame. Gold, obviously, been much stronger, outperforming silver up until recently. Already making a new all-time high above the high that was made in 2011, whereas silver is still well below its respective 2011 high. And based on that difference, the counts obviously look different as well. In the case of gold, we have the majority of an impulse already seemingly being filled out. If this was a primary 1-2, to start off of the 2015 low, then we can view this as an intermediate wave 1 and 2. The move into March as the intermediate 4, and this now intermediate wave 5 to complete the primary 3, and then setting up another primary 4 and 5 from there. Silver, on the other hand, as I said, still well below the high that was made in 2011, and doesn't have that initial 1-2 start because it invalidated any interpretation of this being the start to an impulse similar to gold, when in March it made a new low below the lows that were made both in 2018 and in 2015. So you have to start the count from that 2020 low. So that gives us a little bit of a difference regarding how those two charts are counted, but near term there still can be some alignment between them. And I'll show you that here. So let's zoom in on the 2-hour chart. So for gold, again, the next high we get here could be completing that primary wave 3, in which case I would expect the majority of the move up from the June low to be retraced in a primary wave 4, and ideally taking a decent amount of time to do so. Again, proportionally for this primary wave 4 to look similar in size to the primary wave 2, which was more of a zigzag shape, so that would suggest a possible flat structure for the primary wave 4. So maybe we get an initial strong A wave down, and then a strong B wave back up that could even make a higher high as part of an expanded flat, and then pull back again as the wave C from there, but still eating up a decent amount of time to do so. Even in a kind of the most bullish interpretation that I can come up with right now, zoom out a little bit more here for gold. If I were to view this off of the March low as a 1-2 and 1-2 and this more recent acceleration wave 3 of 3, then price would still be approaching a top as that wave 3 of 3 and setting up a pullback as wave 4 of 3. And really I would, in order to view that more aggressive count as reasonably probable, I would want to see this 100% fib hit before we put in the next local top at 2009 as the minimum standard target for wave 3 of 3 based on Fibonacci pinball within an impulse, to then set up the wave 4 consolidation from there. I don't have the rest of the labels on here, but then wave 5 of 3 would target the 1382. And then a 4 from there. So a lot depends, one, on where this next local high is seen. Again, if we continue to stretch to that 2009 level, more willing to adopt the red count and just look for a pullback as this wave 4 next, which should take us back to the 764 to 618 as support. If we turn down sooner than that, I think a little bit more supportive of the primary wave 3 in blue completing, and again setting up initially a pullback that retraces the majority of the June low as an A wave. Then we can get a large bounce as wave B, maybe even making a new high, and then come back down as wave C from there. Next up on the silver chart, again, difference in the count starting from the low that was made in March. This looks much more clearly like the heart of a third wave more recently, with the outperformance from silver compared to gold. So counting it as 1-2-1-2, and what looks actually complete as the wave 3 of 3 into the high that we saw earlier this week overnight. We got that initial strong drop lower, which actually retraced 382 percentage of the third wave, which is the usual minimum target for a fourth wave within an impulse. But it happened overnight, and it was very sharp and short-lived. So I'm leaning towards a wider flat needed. Whether the B wave completed into today's high or whether it wants to stretch up closer to the prior high and then come back down, and maybe the C wave only revisits that 382, it's something that I want to see printed during regular trading hours. And this high also was made overnight, so we could stretch higher to revisit it during regular trading hours in a B wave, print it on, again, charts like SLV that don't trade during after hours, and then follow that up with a C wave also printed during regular trading hours to give us that nice 3-4 on those charts as well. Moving on to GDX, as far as the bigger picture count, it's kind of in between gold and silver. It has that same primary wave 1 to the upside into the 2016 high like gold, but unlike gold, it did not hold the gold held above the 2016 low and above the 2018 low, so it doesn't have that 1-2-1-2. Instead, the primary wave 2 counted into the March low, but a strong rebound that has now reached normal expected fibs for wave 3 of 3 to the upside. Again, typical minimum fib for a third of third is the 100%. That was at 41.47. So at the next high, looking for intermediate degree wave 3 to complete, set up a pullback as wave 4, which, similar to what I was saying on gold, can retrace the majority of this move up since the June low. And then from there, once we finish that wave 4, head up to the 1382 in wave 5 of 3. which is at 59.41. So looking at the subwaves off of that June low, they look pretty much complete. So this is a situation where I would say the count looks full off of that June low. Need more confirmation of that top in place. That starts with a break back below this prior wave 4 at $40 to start confirming again the wave 3 top in place and price beginning correct pullback as wave 4. Until then, technically could try for one more marginally higher high here, but I wouldn't say that it is clearly set up for that, at least based on the subwaves or micro price action so far off of the recent high. Any questions on gold and silver or GDX before I move on? Let's see. In gold, why haven't you considered the primary correction 2 as a flat correction? This wave 2, so counting this as an A, B, and C, primary wave 2, which is kind of how GDX is being counted. Well, a little bit different because GDX is into the March low as far as its wave 2. Right, so this circle wave 2 getting moved over to the 2018 low is what you're suggesting. I would say that's a reasonable, it's a valid interpretation. It doesn't really affect the rest of the structure or expectations very significantly. Another situation where it's rather than a practical change, more just a difference of academic interpretation. So the fibs could change slightly here. That gives us a 200% at 2003. Could still easily be the primary wave 3 completing at the next high, though. Next question. Avi was thinking the pullbacks will be shallow in gold until we reach 2200. If we're going to stretch that high, it's going to be as the red count here. So again, I would like to see us hit 2009 as wave 3 of 3, and then from there consolidate in wave 4 of 3 back to the 764 and 618, and then we can head up to 2157 as wave 5 of 3, pull back another fourth from there, and then the 176 is actually at 2300, a little bit higher. So those asking for SLV, it is the same count as what I have here on the XAG chart. I just personally track the spot price rather than the ETF. But same 1, 2. 1, 2, 3. So as you can see here, we didn't print that spike down during regular trading hours, so we're missing the wave 4 here, which is another reason why I'm not convinced that it has completed. Even if we do get the higher B wave, I think we'll come back down as a wider flat so that it gets printed on the SLV chart as well. All right, so I think that answers the questions on precious metals. Let's move on to crude oil. So since the low, this is the WTI chart, low that was made in April. At least on WTI, it looks like 3 waves up so far into almost a 1382 fib extension. So bullish interpretation for me is that the next high completes wave 3. We get a pullback as wave 4 to at least this 100% at 2932. And then that could be followed by a 5th wave up from there. Looking at the crude Brent chart, a little bit different than the WTI chart, you can actually get 5 waves up into the recent high, or 5 waves up completing into the recent high as well. So pullback as wave 2. So those are the 2 bullish options. And then the bearish option, ABC up as a fourth and setting up a trip back below or a retest to the April low. So really in all interpretations, price should be approaching a local top soon. Do we have evidence of that top already in place? Not yet. Price hasn't taken out any significant support. Could it still drift a little bit higher towards that 1382 fib at 43.86? It's possible. I don't see really the strongest micro setup on the micro to strongly support that, but again, with no support broken yet, could still try to chop a little bit higher here before turning. But once we get evidence of that next local top, starting with a break back below 39.81 and then really below 38.50 should put the nail in the coffin for at least a corrective pullback as wave for there in blue. And then finally moving on to the dollar chart, which has really shown some recent weakness and accelerating a bit to the downside here. No evidence yet that this is putting in a local bottom. Once we do see evidence of a local bottom being put in, I will view it as either the bottom of that blue wave C of B, it's kind of the bullish interpretation, or a third wave as part of this red wave C, setting up a fourth wave bounce. But with no indication of a local bottom in place, this could still continue to stretch lower near term. Our next fib support level is 92.87 and then 91.85 before we get at least a fourth wave bounce here. All right, so that covers the usual suspects. We have a request for the VXX. I am viewing it currently similar to how I'm viewing the S&P. Possible wave one down complete into the early June low and working on an A, B, C corrective flat for the wave two. Under that expectation, price can turn back up in a C wave, measured move C wave, taking it back to ideally at least 42, potentially as high as 48. However, we need more evidence that a bottom has been struck as this B wave. To start assuming that, we need either 5 waves off the low or at the very least a break back above 31.44. Otherwise, it could stretch a little bit lower. Next support is the 200-day moving average at 27.75. A question from Vinay is, how do we choose to show some 1 day, some 2 day, and likewise 1, 2, or 4 hour charts? Usually any time frame that I'm picking is what I believe frames the relevant information. So I'll pick a time frame where you can see that, what's relevant as far as the count on the chart. So 1 hour chart here shows the relevant information as far as the leading diagonal down and then ABC flat for the wave two. If I was looking at the higher degree chart, I would zoom out. And whatever you personally prefer looking at. For example, Avi likes 144-minute charts. I mean, that's fine to look at as well. Salim, I don't personally follow the currency pairs. I really only look at the US dollar on a regular basis. So if you're looking for analysis on currency pairs, then you would have to take a look at our Forex service, where we have all those pairs posted on a regular basis. There's a request for palladium. Palladium so far has 3 waves up off of the May low. It therefore is either filling out an ending diagonal for the C wave, in which case I would prefer that the recent high could have been all of wave 3 or an A wave of wave 3. If it's going to get all the way up to the measured move here, it should be an A wave of the wave 3. But in either case, support will be the same. So really down to 2036 is about as deep as I would want to see in this pullback for that to remain the more probable outcome. Below there, and that opens the door to the wider flat for the B wave, where this is a larger A, B, and coming down in a C wave to revisit the May low, shown there in red, and then turn up from there. Next question, for the dollar chart, primary account can be interpreted as we are in a fifth wave, but as per you, it is the third wave. Well, fifth wave of either all of a C or of a fifth of a third. So yes, from the June high, this can be a fifth wave. Is that the fifth to complete all of a C wave or the fifth to complete red wave 3? Expected outcome would be the same initially, setting up a bounce. Corrective bounce is wave 4 in the red count, or something more bullish if putting in a bottom 2 B wave in blue. That should, I think, cover all of the requests. All right. What are the targets for the dollar in the blue wave? So if we do bottom in wave B here, I would expect price to exceed the 2017 high, and at the very least target this fib up here at around 106. Since the B wave got deeper, I would probably move this down a little bit. Otherwise, the red count can take us deeper for a wider flat B wave and then turn up from there. Were you asking for the SSEC, the Shanghai Stock Exchange Composite Index? The recent price action here, supportive of a third wave. So as long as support is holding for a fourth, this can extend back to new highs, wave 5 of 3 next, with around 3,600 as the next potential target. Below 3150 first warning sign, below 3080, and something more bearish is playing out. David asked, do I trade the same strategies long and short? So for example, Fibonacci pinball, yes, can be applied to an impulse in either direction. And the setups on individual stocks that Zach and I like and have recommended are tagged wave setups in that service. And we go over them during webinars and the daily videos as well. And a request for the Nifty. So let me zoom out here for Nifty, very similar kind of large degree count, primary wave 4 complete into the March low, and I think still just the initial wave 1 of primary wave 5 here. But with price continuing to extend recently to the upside, it looks more like a 3-wave structure off of the March low as an ABC, implying that the primary wave 5 will be an ending diagonal rather than the standard impulse. So it can be coming into a top as the wave 1, very similar to the expectation for everything else, setting up a wave 2 pullback, just as part of a larger ending diagonal. Another question, do I cover foreign index ETFs in the World Market Service? I do not. The problem with the foreign index ETFs is that they are priced in a different currency than the native chart, and they're priced in US dollars. So that currency skew really changes the structure of the chart. It, in most cases, looks nothing like the native chart. So regarding gauging sentiment, I think you're much better served looking at that native chart and, if possible, trading that native chart as well in the native currency. Is another low still likely on the SSEC? Below 33.25. Oh, I see what you're saying. Another low in this wave C of 4. It was not the most satisfying move down as the C wave here, but it's getting a little bit high for a fourth wave bounce within the C. I mean, doesn't technically invalidate until above 33.25, like you said. It would have looked better with one more low, but again, it's getting a little bit high for that bounce. I mean, technically, because of that, I would also, and I'll put that, I guess, on the chart in red. So we are going to view that as complete there. It could be even a wider B wave, starting to get a little bit big for the size of this fourth wave, but at least technically a possibility. All right, that should be all of the questions and requests. So I hope everyone has a wonderful evening, and I'll see you guys again next time. Take care.